So Seville is asking, I have substantial annual income in my Roth IRA, so individual retirement account in the US. So his question is, how is my Roth? Because the Roth is going to be tax-free in the US. So how is it going to be taxed, if it's going to be taxed in Portugal? Augusto?
Okay. The important discussion is, in this case, to clarify the nature of the income deriving from the Roth. I would say that in principle would qualify as a pension income if received in several installments after retirement. So in such case, if we can confirm this nature as a pension income, that would mean that the pension income under these new rules of the NHR regime would be taxable in Portugal at a flat rate of 10%. However, it is important to clarify that this 10% may or should only apply to the component received of the pensions received that corresponds to income, meaning that we should not tax the amount received in the pensions that correspond to the capital contributions made by the person. So the challenge would be to, in each pension income, to split and only tax the income and not the amount of the contributions that were made by the individuals to this product.
Okay, so I know that, you know, when we say this, because this is a question that we always get asked, and after we give the explanation, there's collective disappointment, right? Because people were under the impression that there's a DTA, and it's still being bandied about online, right? So there's a DTA, so you're not going to be paying any tax in Portugal, and that is wrong. And for those who may be new, you can look at what has been happening in Spain right next door for forever, right? So the way it works is that Portugal will tax it. But as Augusto has said, we're going to have to bifurcate, or whoever's working with you, you know, whoever your chosen tax team is, they're going to need to bifurcate that monthly income between what was the original contribution and what is the return on the investment. And the return on the investment will be subject to the 10% tax. Now, then we get, so then you're saying, well, what about the treaty, right? That's in violation of the treaty. Not exactly. So just like happens in Spain, for those who, you know, may have spent time in Spain, or they have friends, or they're connected with people, Americans who are in Spain, you do invoke the treaty, but what you do is you reclassify that income, even though it was derived domestically. And this is strictly in a US tax return, right? Has nothing to do with Portugal. Portugal has got their piece already and they're happy. So on your US tax return, you're going to invoke the treaty and reclassify that income from domestic to foreign income. And then you get a foreign tax credit, which would be usable to offset against any other tax liabilities that you may have to the US. So, you know, so the point is that it is not straightforward. And when you sit with your preferred tax advisor, they can walk you through. And in a case like this, where you still may be in the US and planning to come to Portugal, it creates planning opportunities, because the NHR, as readily apparent by now, it's very nuanced. So before you arrive in Portugal, you may want to contact an advisor and go through all your income and go through all your assets and understand how Portugal will see it. And if you don't like how it's going to be treated by Portugal, then you have an opportunity to plan before arriving here. So it may be a planning opportunity. So that's it as far as Roth is concerned.
subscribe, like, share, and comment below. Our books and upcoming event are available at htj.tax. Email us at help@htj.tax to engage us, to advise on international tax or business matters.